Hi, and welcome to the ZEROTAX.ZONE Podcast with Andrej Kandus, your host. Tax savings and structuring is a very sensitive topic, and unfortunately one that is mostly ignored until it is too late. That's why Andrej decided to launch ZEROTAX.ZONE Podcast. So let's jump in. What can you expect from this podcast? Well, each week, we bring you cutting-edge insights and advanced strategies designed to help maximize your deductions and save on taxes like never before.
Okay, hi, this is your host, Andrej Kandus, speaking again, checking in again. What we're going to do today is we're going to start a mini series on a subject that is of huge importance to most people, but they realize about its importance, obviously, sometimes too late, or very many times too late, because it has to deal with retirement planning. And it specifically deals with taxes in retirement. There's a huge number of possibilities to retirement plan, and the traditional world of retirement planning usually has to do with, okay, how do I invest my money to make the most of a return, and does not really cover or does not really care so much about the taxation, kind of thinking about taxation as just something that is there that you cannot do anything about it. But in fact, you can do a lot about it. And if you plan accordingly and plan soon enough, you can actually reduce the effect of that taxation substantially, which effectively means that you may double or triple or even quadruple your retirement income just by careful tax planning before you retire or close to your retirement. So I'm first going to cover some really big pitfalls or issues that you may or may not be aware that exist. So anybody that has substantial savings in their traditional IRA or a 401k or a SEP plan or any of the tax-deferred retirement plans really has to deal with these issues. And the first issue that I'd like to address is just general taxation, because distributions from a retirement plan are treated as regular income. So regular income is taxed as regular income, and you would think that your tax rate was going to be lower in retirement than before because, you think it's just going to be, for whatever reason, people think they're going to have to pay less taxes. The typical situation is actually the opposite. What happens is you usually have either paid off your mortgage or you're closer to paying off your mortgage. You're not going to have another 30 years to pay back your mortgage. You probably started with that mortgage quite a while back, so that deduction is going to go away. What goes away is you probably don't have kids at home anymore, so that deduction is gone. And these are typically, the big deductions, and there's a lot of other deductions that also go away. And so you end up with an income that you need in order to live your lifestyle, but it's going to be much more heavily taxed than when you had that mortgage and kids at home and all those other things. So that is the first issue that is quite substantial. The second issue is what most people don't even realize that exists. There's a concept of provisional income. Provisional income means that your Social Security income is either not taxed or taxed. What currently triggers taxation of Social Security income is the amount of other retirement income besides your Social Security income. So suffice to say, on a very high level, if your Social Security income is your only taxable income, if that was your only taxable income, you would pay zero tax if your Social Security is around $30,000. This amount changes year by year as adjusted for inflation and cost of living. But let's say about $30,000 is not taxed if that is your only taxable income. However, if you were successful and if you saved well and you have money in your deferred accounts, then that distribution, whatever distribution you take, is going to trigger the taxation of Social Security income as well, because now you're considered a wealthier person. So your income is now going to be a combination, is going to be a sum of your Social Security income and your non-Social Security income, which typically would come from a from a deferred account. So, you're completely unnecessarily losing taxes on Social Security, which could be, $10,000, $15,000 a year, completely unnecessarily if you planned accordingly. So that's another issue. The third issue is the cost of Medicare, the increased cost of health insurance for the people that retire. So if you are considered wealthier, which you have, if you have a combination of your Social Security income and your distributions from a 401k, that is going to trigger the increase of your Medicare cost. And it could be $5,000 or more a year in additional cost. So if we go back, if we've paid $10,000, $15,000 additional taxes on Social Security, another $5,000, this is already $20,000 a year that you may be losing because of the tax planning that just was not good enough. The third issue that I'd like to really point out is what is called required minimum distributions. Most people know that exists, but they don't really understand how this can affect them. The challenge of this is there's the required minimum distributions is a concept where the government is forcing you to take out a certain percentage of your retirement assets every year after a certain age. And this age also kind of is shifting to a later age, but it's currently, I think it's about 72 or 71 and a half or 72, where at that point you have a requirement to take out a certain percentage that increases every year after that. So it typically is an amount that is quite high if you have a large amount saved in your 401k. What that means is that you're forced to take out more money than you actually need, and you're taxed on it. So you're taxed on that, you're taxed on your Social Security, you've got your Medicare increases. So you're forced to unnecessarily take out more money that you need and pay taxes on it. So at the end of the day, you're hit 3 times. You're hit with the taxation of your Social Security income, you're hit with additional Medicare costs, and you're hit with RMDs that are forcing you to take out unnecessarily large amounts that you don't really need. And if you don't, there's large penalties that you're going to pay for not taking it out. So what on earth can we do about it? I mean, is there a way, right? Is there a way to mitigate this? And you know what? There are ways. There are very, very good ways to do that. It is very important to plan ahead. And typically, these solutions that are the most efficient, they take about 5 years to refunnel, to reposition your assets in a way where we can what we like to call untaxed retirement. So we call it an untaxable Roth. And most people understand what a Roth conversion is. A Roth conversion would be converting, and a backdoor Roth means that you can take your deferred accounts and you can convert part of that account or all of the account into a Roth type account. A Roth type account is an account that you have paid your taxes on, but then you pay no more taxes later, which means you pay no tax on growth and no tax on distribution. But first you have to convert a deferred account into a Roth, which typically means a very large tax hit, especially if we're talking about large sums of money. So the question is, can we achieve the same effect? Can we convert your deferred account into a Roth type structure with a substantial tax savings, a tax relief, so to speak, on the conversion? And the answer is yes. And what this means is actually, if we can save taxes, if it's just save half of the taxes on that conversion, that does not mean that you have twice as much money. That means that when this money compounds, you could have 2 or 3 or even more times the net income in retirement, just because you've planned carefully. And you've eliminated, because of that, you've eliminated the taxation of Social Security. You've eliminated the RMDs, and you've eliminated the increase in Medicare costs. So just by the fact of this alone, you may be saving $20,000 a year that you could have used for your own retirement. This could mean a difference between running out of money and not running out of money in retirement. So today, I don't have enough time to cover the strategy in detail, but I'm just going to give you an idea of what this could mean to you in a typical situation where, for example, you might have $1 million or $2 million saved in your retirement accounts, and you're hoping that that's going to be enough to provide you with enough income so you can live until the end of your life without worrying about money. The challenge is, if we just take a very simple math, which may be a little bit too aggressive in this calculation, but just as an educational exercise, just as a mental exercise, if you have to pay 50%, if you live in an expensive state like California or New York, you might have, if you're distributing large sums of money from your retirement account, you may be paying potentially 50% in taxes between federal and state. So, $1 million is going to mean that you really have a partner in your retirement account, which is the government. So only half of that money is really yours. And you think, well, $1 million is a lot of money, but in fact, if you only keep 500,000, that if you need $50,000 to help you with your retirement income, that means you only have 10 years and you're run out of money. So can you actually live on this amount of money if you only keep half of it? And that money is goes down to zero in 10 years. Instead, if you could convert that million into a Roth with a minimum or no tax hit, so you get a tax relief on that conversion, which is really the topic. The details of how that can happen is really a topic for a whole episode. But assume that can be done. I just want to give you an idea of what that means, what that can mean for you. That can mean not having the keeping twice as much money in the long term does not mean doesn't mean twice as much income, but it actually can mean more than twice as much income, because first of all, you've converted your deferred account into a Roth type structure, which means, again, I have to remind you again and again, because that's a lot of time that's not really understood well. By doing that backdoor conversion, but not the regular way, but the way where we can reduce the tax hit by a substantial amount, but one way or another, you're going to have a situation where you have no pressure on RMDs. The RMD is eliminated because RMDs are not required on a Roth type structure. There's no taxation, there's no provisional income, so there's no taxation of Social Security, and there's no increase of Medicare costs. So what we see in a lot of these situations is that people can at least double their retirement draws, basically their retirement income, at least double or maybe even triple their retirement income with the same amount of money. It is just this money is much, it's not taxed anymore, because after the conversion, there's no more tax that needs to be paid on it. So this is as much as really I wanted to cover today. I wanted to kind of give you this, I want to plant this thought in your mind and kind of get you motivated to learn about these strategies much better. And maybe you're exposed to this idea for the first time in your life. But if you are, it doesn't really matter how old you are. It just, whatever matters is maybe it's good that you start taking care of this issue, possibly before your retirement. Even potentially if you already started your retirement, but you just retired, there's still hope. There's still ways to do it. But it's best if you have a little bit of time. Let's say if you start repositioning your assets, let's say 5 years from when you actually plan to retire, that would be a perfect time, or even sooner. The sooner the better, actually. But the question is, are you ready to even discuss this subject? A lot of younger people don't really think about this. They think about this topic of something that's going to happen later. But I tell you, I mean, we've done these solutions for 30, 35-year-olds, and those guys are going to be golden in retirement, because the longer the repositioning of assets works in your favor, the bigger that multiple is going to be. So, we're talking about the difference between, in $1 million example, doubling or tripling. So instead of being able to pull out $50,000, maybe you're able to pull out $100,000. What would that do for your retirement lifestyle? That potentially can mean that you can stay where your kids are. If they're living in an expensive state, you don't have to move to a really inexpensive place. You can still do it, but you're not forced to do it. So it really helps you. It totally changes the landscape of your retirement lifestyle. So I would encourage you to really pay close attention in the next episodes, where we're going to dive into more detail. But just know that it really is worth your effort to learn about this and understand these options. All right. So more next time. Thank you very much for listening, and we'll talk to you soon.
Thank you for listening. We hope you enjoyed our podcast. We will have a weekly podcast covering everything tax related that will help you not only grow, but exceed your tax savings. Looking forward to seeing you soon.